the average time to sell a property has increased up to 33 days more. A very long time, interest rates were almost 0%, in which case debt was cheap and there was a lot of money supply in the market, which actually ended up in asset price. When it comes to understanding investments in any sector and any assets, you have to follow the signals, not the noise. Even though there's clear signals that tell us the property market is softening, the question is, will it crash? And the final signal you'll see is, this happened recently, people desperately want to buy houses. But what is even worse about that is right now, I strongly believe that I'm Lloyd James Ross, 7-figure investor and entrepreneur, and I've helped thousands of business owners and professionals turn financial stress into success. If you're stuck in old money habits, overwhelmed by investing, or unsure where to start, this is for you. I'll give you the mindset and strategies to take control, grow your wealth, and achieve financial freedom. It's time to make your money work for you. Is the Australian property market collapsing? What a great question. I will tell you the answer and what I think at the end of this episode, so stick around for that. But what made me do this episode was this. Recently, the Australian Treasurer Jim Chalmers sanctioned banks to not account for student HECS debt when calculating the serviceability of their mortgage. In a nutshell, what that means is they're actually incentivizing the demand for more property by letting more people buy that probably shouldn't be buying. So HECS debt, or university debt, college debt, needs to be paid back, but you do only have to pay it back once you've got a job. So if you don't have a job, you don't pay the interest on that debt. However, most people with HECS debt do have jobs. But what that means is when they're going for a loan at the bank is not taking the HECS debt under consideration when it comes to serviceability. So they're actually selling mortgages that will put these students in more financial difficulty, which is a really dumb decision. So if you want to buy a house, you have to definitely see if you can service the debt. So when the bank does the calculation, they look at your assets, they look at your income, and they have a computer that says, hey, at these interest rates, with this much debt, this person can easily service this debt. Now, unfortunately, when you don't take into consideration other debts or other things, then you're actually putting that person in harm's way when it comes to their finances. But people desperately want to buy houses. But what is even worse about that is right now, I strongly believe that the housing market has gone through a massive run. So the people clamoring to get onto it now are really coming in at the peak because we're actually seeing signs that the market is coming off its high. But before I jump into that, here's some median house prices across Australia right now. This will blow you away. Check this out. The Gold Coast is $1.5 million median house price. What's weird about that is Sydney is also 1.5 million. Now, Sydney has got the most valuable houses, or certainly the house with the most price, or the highest price, but the Gold Coast, a smaller place. There's only 700,000 people that live on the Gold Coast. Its median price is the same as Sydney, 1.5 million to buy a house. Looking down at the other capital cities, Melbourne is way down the list, 990,000, because people are moving out of Melbourne. It's not the city it used to be after COVID. My dad jokes that Dan Andrews is the greatest Gold Coast real estate agent. He's won Gold Coast Real Estate Agent of the Year for the last 4 years. So he was the Premier of Victoria, and he was the one that led Melbourne through COVID. And I think it's easy to see that that didn't really bode well for the city because real estate prices there are lower than even the Gold Coast, 990,000. But check this out. Brisbane, the third largest city in the country, median prices are 938,000. So much less than even the Gold Coast. And moving down the chain further, we've got Hobart, 800,000. But check it out. Perth, median house price, $766,000. So if you're a property investor and you look at that, Perth is probably the 5th largest city in the country, and it's actually got median prices that are more reasonable. So I dare say what we'd see over the next few years is Perth actually having a more stable and perhaps even growing property market without the corrections that the other places like Sydney, Gold Coast, Brisbane and so forth will have coming in the next few years, all right? So are prices falling or rising? Let's have a look at what the data says, because when it comes to understanding investments in any sector and any assets, you have to follow the signals, not the noise. Okay, there's a wonderful book called The Signal, Not the Noise, but we want to look at signals, market signals that dictate what the market is doing. So there's 5 clear signals that show us what is happening. The first signal when it comes to asset values is interest rates. Interest rates are to assets what gravity is to us. It will dictate the movement in assets the most out of anything. A very long time, interest rates were almost 0%, in which case debt was cheap and there was a lot of money supply in the market, which actually ended up in asset prices. So you saw interest rates falling down and assets value rising. So in economics, there's an inverse correlation between interest rates and asset prices. So if interest rates are falling from 1980s at 17% down to almost 0, you're going to see massive inflation in assets, which is exactly what we saw in real estate. We've had probably the greatest real estate boom in the history ever in the last few years. And so now interest rates are going back up. In fact, they went up to close to 4.5%. They've just dropped recently to 4.1, but I really think that was a political move. So what we're seeing now is because interest rates are higher for longer, and you probably won't see them drop anytime soon beyond this, we're going to see people starting to feel the pinch when it comes to paying their 6.5% P&I rate on their home loan. And they're starting to hurt, which you'll see in a second when I show you another signal. But high interest rates is the first signal we're going to see a softening in the housing market. The second signal we see is that there's increased property listings, okay? So if you look on CoreLogic or Reuters or any particular research portal, you'll see that the total number of property listings has risen by 5% compared to the previous year. This indicates a shift towards a buyer's market, okay? So an increase in property listings mean people are starting to list their houses. They either see that this is the time to sell and they're late to the party, or they actually can't pay their mortgage anymore and they're ready to actually sell under distress, all right? The third signal we see is extended selling times, all right? So the average time to sell a property has increased up to 33 days more, all right? So it used to be 28 days to see your property sell. Now it's increased by 33 days. So we're seeing more urgency from sellers to sell, but less buyers wanting to buy at current rates and current prices. So we're starting to see, if you look at realestate.com and other real estate portals, you actually notice, if you look even a few months ago, there was a price here and you're starting to see on ads, price reduction, make all offers considered. These types of language patterns on ads show us that vendors are starting to get a little bit desperate with the prices they had, or they just had way too higher expectations when it comes to their houses. We're starting to see that start to come down now, all right?
Just quickly, if you're ready to take control of your finances but feel stuck on where to start, I have a solution. My book, Money Buys Happiness, simplifies investing and wealth building with practical steps to help you achieve financial peace. Get your copy via the link in the show notes and let's get your money working for you. Now back to the episode.
Next point, the next signal is auction clearance rates. So the auction clearance rates are starting to fall drastically. And what we used to see was about 85 to 87% auction clearance rates across Sydney, Brisbane, and the major capital cities. What is happening now is auction clearance rates are around the 70% mark, which means that less are clearing from auctions. So we're seeing vendors and buyers, so sellers and buyers, they're not meeting the mark together as much as what they were. So probably what we're seeing is the values are too high and buyers probably can't afford it anymore because rates have gone up. So there's a big mismatch there than what there used to be. And the final signal you'll see is, this happened recently in the news, that National Australia Bank fell 14% in its share price just in the last 5 days. So you see NAB share price last 5 days, boom, fallen 14% due to 38% rise in bad or doubtful debts, meaning the clients who have got, or customers of the bank who have taken out a mortgage, because rates are higher, they're starting to see doubtful debts happen. So they're starting to default on their debts because they can't afford their mortgages. So this is a surefire sign that the banks are starting to encounter mortgages that can't be serviced. And that tells me it's another signal we're seeing a softening in the property market, meaning less people were gonna buy, all right? So even though there's clear signals that tell us the property market is softening, the question is, will it crash? And if you look at the immigration, chances are it's not going to crash because there's so many people moving to Australia. So in 2019, there was about 239,000 immigrants a year coming in. And since then, 5 years later, that number's jumped to 660,000 people. That's the whole city of Canberra every year moving to Australia. It's the highest immigration we've ever had. So if you think about that, more people equals demand is going up. And if inflation has prevented building supplies from staying low and there's less construction, which is a fact, there is less construction. A lot of builders are going out of business and going broke. There's not as much supply. So if we have steady or falling supply and rising demand, of course we're going to see prices stabilize or go up. So I don't think we're going to see drastic collapse. At the same time, we're not going to see a drastic rise either in prices. What we may see is pretty much a plateau for many years to come. What does that all mean, and how does this kind of fit into what will happen with property? Can real estate fall? Yes, it absolutely can. I think it would be silly of you to think that it can't fall drastically, even though we do have more demand and less supply. If the next government switches off immigration, we're going to see an adjustment in real estate faster than what we used to. But also, if you look at history, it does show us that real estate can and probably will absolutely fall by a fair amount. If you look at the United States, in 2008, they also had lax lending that's happening now in Australia, and they had a high demand for housing. And of course, what happened there was a lot of people were borrowing money that shouldn't have been, and they were buying houses. And if you look at the housing crash there in the United States, prices fell. Once the bubble popped, house prices fell by about 33%, which is actually a tremendous fall from their highs. And going on from there, if you look at Japan, so Japan had a housing bubble in the 1980s. It was extreme. It was very much very similar to what's happening here right now. And if you look at what happened there, prices fell from the heights in 1991, and prices haven't grown for over 35 years. So right now in Japan, houses still haven't recovered the losses they experienced in the early 90s because the prices were bid up so much. And they call it the lost decade, but I look at it the lost 3 decades of housing price accumulation in Japan. And that's the second, well, up until China, was the second biggest economy in the world. So of course, housing crashes can happen because in China, it's happening right now. Prices have been falling for the last few years as oversupply has now hit the market, and the population didn't quite catch up to housing. So that can absolutely happen in Australia too, because if we turn off immigration, we are going to see less demand. We're going to see a catch up in building because of land prices going up. And what we're going to see is a big correction in housing. Now, whether that's going to come now or in the future, not too sure, but certainly it can do it. So don't think for a second that housing can't fall, because it happened in the 3 largest economies in the world at a fairly substantial scale. So will it happen in Australia? The signals tell us that it's softening, but the immigration numbers and demand and short squeeze of supply tell us that it won't be drastic. So if you're wondering what's going to happen, in my opinion, what will happen is we'll see a plateauing for quite a number of years in the housing market. So if you're rushing out to buy a place in case it's going to go up and you want to join the Ponzi, chances are it won't, because people cannot continue to buy beyond their average wage of $100,000 with interest rates at 6.5%. If inflation goes up even further, it will mean rates will go up even further, which will make it even harder to buy. So demand is definitely softening, even though we're seeing record immigration. And the reason why they're doing that is so they can keep GDP steady to win the next election. It's completely political. Hopefully they change the tune, but that is what I foresee happening when it comes to whether we'll see a collapse in the Australian housing market. So I hope you enjoyed that episode. If you haven't done so yet, click the subscribe button, cha-ching, and then go and check out the next videos and leave a comment below. What do you think about what is happening in the Australian housing market right now?
Thanks for listening to Money Grows on Trees. If you enjoyed the episode, leave a 5-star review on Apple Podcasts and Spotify, and subscribe to us on YouTube so you never miss an episode. And if you're serious about building wealth, make sure to check out the links in the show notes and follow me on all social media platforms at Lloyd James Ross for more. See you in the next episode.